Hello. Hi, everyone. Thanks for joining in today. Happy to, host this session. Apologies for the slight delay that we had in terms of starting the session, but hopefully we'll be able to cover a lot through the rest of the evening. So today we're going to talk about our latest portfolio enhancements that we've done on the Syfe side. But before we go into that, let's do a quick, run up of the agenda as well as, the market outlook to begin with. So quickly, we have the introductions, then we will quickly do a market outlook. We will cover some of the um, key rebalancings that we have done on our core portfolios. In fact, we will also have our host from Dimensional coming in to talk about factors and giving those insights as well. And at the end of the day, we have a diversified portfolio that is across equities and fixed income. So we'll cover the fixed income piece subsequently. So let's move on to the next section. So all of you guys know, so I'm Ritesh. I head up the investment and advisory business at Syfe. I'm joined today with Aman, who is the head of portfolio construction and quant research here with me. And alongside us today, we are privileged to have Wei Dai with us. So she is the head of investment research at Dimensional. Thanks, Wei, for joining us today. Awesome.
Yeah, thanks for having me.
Thanks, Wei. All right, so let's move on to the next section. Yes, quickly. As you all know, we are Syfe's. We are Syfe. We are an all-in-one investment platform. We are, in a way, the most versatile platform out there in the market with, a one-place solution where you can manage your investments, whether you're looking to save better, whether you're looking to invest for your long-term, goals, or you are looking to DIY and invest into individual securities. You can do it all in one place. Also, just moving to the next slide, in terms of our journey so far, it's been 6+ years. And over the course of these 6 years, we've achieved, various milestones, including, expanding into different geographies, launching of new products, as well as securing new rounds of funding as well. So overall, if you go into the next slide, we are now managing north of $10 billion in assets, trusted by over 250,000 clients just in Singapore. And of course, now expanded our offerings across Singapore, Hong Kong, and Australia. All right, so with that, let's quickly cover the market review. If you go on to the next slide, obviously, equity markets have done incredibly well this year. They have continued to make new highs in spite of all the headlines that would have suggested that they don't, right? And it started off with the Mag 7 and the AI pullback when we had the DeepSeek moment in China earlier this year. And post that, we had the Liberation Day when Trump announced the sky-high tariffs across the world. That led to a big sell-off, in fact, 20+% down on the market with that news bite. Subsequently, we saw a thaw because the tariffs were paused, which gave chance for negotiations. At the same time, we saw other things unveiling itself in terms of geopolitics. We saw the Middle East military escalation, as well as there was some escalation back on the tariff side between US, China, and some of the other countries as well. And more recently, we are now seeing concerns around whether there is an AI bubble or not. And we'll address this subsequently as we move forward too. But overall, the equity markets have continued making new highs through all of this noise. And if you go on to the next slide, we are talking only about not just the S&P 500, which is the US market, but if you zoom out and look at returns beyond the US market as well, essentially, you've seen high double-digit returns across the world. And in fact, most of the markets ex-US have meaningfully outperformed the US market in terms of returns for 2025. And that's a reversal of sorts coming into 2025 compared to a lot of previous years, especially if you look at emerging markets, developed markets, ex-US. In fact, like looking at Europe and Japan, these markets have generated north of 25-30% returns over the course of this year. And obviously, gold has, in this meantime, continued to also shine through pretty, thoroughly. So you see that the gold as an asset class has rallied more than 53% in the same time period. And the more important piece here is, also the US dollar. This has also been an year where there has been questions about US exceptionalism, the de-dollarization trend, and what that has meant is the US dollar has weakened considerably across other markets. In fact, 8% down year to date. That basically means the bar for US dollar returns has just gotten higher. So if you're generating 17% return from US equities, actually your net return, for example, in SGD might be less than 10%. So if you are looking at investing going forward, obviously you need to also think about not just the US market, but diversify your exposure beyond the US market and also from a currency standpoint beyond the US market too. So if you go on to the next slide, that brings us to the 2026 outlook. And there are three themes that we believe will define 2026. So number one, is there an AI bubble or not? We will know as we move forward. At this juncture, we don't think there is an AI bubble, but definitely there are some signs of froth. Number two, we believe factor strength is starting to emerge, right? And there are aspects of growth that we are seeing beyond just the mega cap tech names. So there's definitely a broadening of the rally across sectors, across factors, as well as across geographies. And more importantly, as we see the US dollar continue to weaken into 2026, emerging markets in Asia are poised to do strengthen on the back of that and deliver much more and superior returns as well. So just going in a little bit deeper on these aspects, if you go on to the next slide. So obviously the big elephant in the room is, are we in a AI bubble? And if you look at data at this juncture, yes, there is some froth in the market and there is some concerns in the market. Like there is a lot of circularity that we are seeing in the AI spending. The capex has grown to $350 billion in US dollar terms for 2025 and poised to continue growing over the next couple of years as well. Now the question is like, what does it translate to in terms of actual returns? And also at this juncture, while the capex spendings have been pretty high, the reality is these are mostly funded from the cash flows that these mega cap tech companies are already generating. So that's also a little bit of a deviation and a difference between the kind of spending that we are seeing right now versus the kind of dot-com era bubble that we had previously seen. So these are highly profitable company, very good cash flows, and they're using those cash flows to incur these spendings. Now, does it translate into actual returns? That's something that we will see as we move out into 2026 and 27. But the general view is that it will definitely lead to productivity growth and productivity growth to the tune of 2 to 3% per annum. And that basically means that we are still very early in the AI adoption cycle. And what that means is if you go on to the next slide, in terms of valuations, yes, we do believe the valuations look a bit stretched, but that also calls for the diversification beyond just the mega cap tech names, and selectivity becomes much more efficient, much more essential. One earnings miss could have a pretty big impact across the markets, and we know that Nvidia is about to unveil their earnings tomorrow. So we'll see how that pans out and what kind of impact that has on the market as well. But on the broader scale, I think it is the broadening out of this rally which is much more important. So that brings us to the theme number two. And if you go on to the next slide, essentially one of the key things that we have been observing over the course of this 2025 is that markets ex-US have started to rally quite significantly. And that's a function of both the equity markets starting to look better and earnings momentum starting to pick up into geographies beyond the US, but also the US dollar depreciating. And most of these countries, the value has been unlocked through the factor exposures and sectors which are beyond just the tech names, right? So the value sectors, the value as a factor has started to emerge, and especially in countries such as Europe and Japan leading that pack. At the same time, there is also sector diversification that is showing up where sectors which are not just driven by the growth story of the AI ecosystem are starting to see some benefits emerge because of the capex spending that we are seeing on the tech side as well. So if you go on to the next slide, basically beyond just the broadening of the rally, which we believe will continue in 2026 across sectors, across geography, and across factors, the other big aspect that we are positive about is the emerging markets in Asia. And this is where we see the weakening of the US dollar to resume in 2026. And historically, whenever US dollar has weakened, emerging markets in particular has done incredibly well. So you can see in this slide that emerging markets have, on average, generated more than 20% returns over the course of 12 months once the US dollar weakens by more than 10%, right? And this is where we have the conviction in the US equities, which will tend to outperform developed markets when the US dollar weakens as we go into 2026. And if you go into the next slide, just like, the signs have already started showing up. Emerging markets is already regaining a lot of momentum. And this is after years of underperformance. And what that means is as you move forward as well, when it comes to returns going forward, the emerging markets are set to deliver the strongest returns in 2026 and beyond on a more global basis as well. So from an investor positioning standpoint, if you think the AI rally has run its leg, not yet maybe, there is definitely more volatility that you should be worried about. And that, in a way, if you summarize this whole thing, calls for diversification in geography terms, diversification in terms of sectors as well as factors. And more importantly, here in Asia, the allocation to emerging markets is a thing that we should be looking at much more strongly as we move into 2026 and beyond as well. And that, in a way, like sets the stage for the next stage of our discussion. I'll just quickly cover how our core portfolios are designed to capture some of the global growth prospects of the equity markets and some of the enhancements that we have done as well with our core portfolios, something that will go into much more of a deep dive along with Aman and Wei as well. So if you go on to the next section, our core portfolios are globally diversified. They are invested across asset classes, across geography and sectors. So if you go on to the next slide, in terms of the core philosophy, the reason we have created these portfolios is because there is fundamental underperformance when it comes to a lot of the active managers that are out there trying to beat the market. There is a lot of emotion and biases that come into play. There is lack of transparency, and often it is with very, very high fees that you're paying to do these investments for you. And this is what the core portfolio solves for you. If you go into the next section, we have created these portfolios with a few things in mind. Number one, these portfolios are globally diversified. We use the best in class and the lowest cost ETFs to get the right kind of exposures for you on a global basis. These are expertly managed by me and my team, and alongside working with key managers such as BlackRock, Dimensional, we have them here today. Our intent is to maximize your long-term returns. If you go on to the next page, in terms of our investment approach, there are three key elements to it. Number one, how do we do portfolio allocation? How do we incorporate factors? Number two, and number three, how do we then overall optimize it? If you go on to the next page, the first principle, just elaborating a bit more on that. One thing important is if you're allocated 60-40 into a bond and stock portfolio, that does not mean that your risk allocation is 60-40. And this is a very important concept because when it comes to returns and risk, from a risk perspective, even though you have 60% allocated to, say, stocks, the reality is when the markets go down, the stock portion of your portfolio will go down by much more significant amount compared to your bond portion. And that basically means that the risk contribution of the equity side is much, much larger. This is something that we incorporate when we are constructing our portfolio to make sure that we are constructing it from a perspective of not just generating returns, but also allocating adequate risk to make sure that you are generating returns from a risk-adjusted basis. If you go on to the next slide quickly, how do we incorporate factors? These are rule-based quantitative factors. These have been designed to outperform traditional markets, and they have been selected with a thorough process and with huge amounts of research backing it. So in terms of key factors that we incorporate in our strategy, they are basically the value, quality, size, and country. More on quality later on in terms of some of the key enhancements that we have done in our portfolio, specifically on the value and quality aspects of it. We'll be happy to cover that in the next section. So quickly, the portfolios, again, we have four different portfolios: 100% equity portfolio. Then there is portfolios with varying amounts of equity, bond, and gold, gold being part of the commodity section. And the idea is, depending on your risk tolerance, depending on your investment time horizon and the specific goal that you're trying to solve for, these portfolios are purpose-built to solve for all of these specific needs of you. Lastly, in terms of how these portfolios, yes, next slide, please. How these portfolios are constructed, again, like, when it comes to returns over the long term, what is important to note is it is not really the market timing and security selection that drives long-term returns. It is the asset allocation. And this is where we spend a lot of time and effort to make sure that these portfolios are well balanced, well diversified, and well optimized to drive these long-term returns for you. So lastly, in terms of how that translates into actual long-term returns, just go on to the next section. All of our core portfolios have either tracked or done better than our benchmarks. If you look at across our equity portfolio, the growth, balanced, and defensive portfolios, obviously some of the factor exposures like value and quality don't always result in outperformance, especially in certain periods like the last few years when growth stocks have done incredibly well. But having said that, as we have covered in our outlook and the positioning going forward, we do believe these are the right kind of exposures that we want in our portfolio, and these are the exposures that will position you well in terms of having a resilient allocation to drive that long-term performance as well. So with that, I'll hand it over to Aman quickly to cover some of the key enhancements that we have done to our portfolios.
Thanks, Ritesh. On to the next slide, please. Now, there's three key enhancements we've made in this rebalance. First, we've increased our global diversification further, broadening from US equities into international markets. Within the US equities, we've enhanced our factors exposure, strengthening our quality exposure through the addition of systematic high profitability. And finally, we've refined our multi-asset exposures using both adjustments with fixed income and our gold allocations. In this section, we'll cover the first two themes concerning our equity component. Next slide, please. So our first enhancement is moving from US equities to international markets. Now, of course, we've always had global diversification in our core portfolios, and US equities have had an incredible run, but they now represent one of the most expensive markets. At the same time, we're seeing signs of renewed strength in Europe, Japan, and emerging markets, helped by a softer US dollar and renewed signs of growth. Now, broadening globally helps us capture these opportunities and reduces concentration risk and our reliance on a narrow set of US mega caps that have driven recent returns. Within emerging markets, we've maintained our long-term conviction, especially in China, which has rallied over 35% year to date. Now, China still remains structurally underrepresented in global benchmarks, but our exposure there stays measured and intentional. Next slide, please. Now, rather than just simply reducing the US allocations, we've also refined the allocations to strengthen our factor balance. Namely, we've strengthened our existing quality exposure through the addition of systematic high profitability, through the addition of dimensional US high profitability ETF, the UHP. Now, high profitability tends to hold up well in periods where size and value, the other factors, can lag, including recent years. By strengthening our existing exposures, we've added resilience to go through varying market cycles. DUHP invests in large cap and mid cap high profitability stocks in the US and overweights mid caps, lower relative price stocks, and higher profitability stocks, combining multiple factors. As a result, size and value have been trimmed modestly as part of a wider balancing of our factors. This isn't because we've lost conviction, but to create a more balanced mix of factors moving forward. Our growth exposure has been tempered to reduce concentration, particularly in mega cap tech, which has had an incredibly strong multi-year run. Wei will go into more detail on high profitability and factors later on this evening. Next slide, please. Now, bringing this all together, we have our overall equity allocation. And don't worry, we appreciate this is a lot of information. This will already have been emailed to you following our rebalance and is available on our website. I won't go through this line by line. The first two sections highlight the changes within the US, namely our overall reduction in allocation, as well as the factor adjustments we've just discussed. The final section highlights our increased international markets exposure and modest trimming in China, given the significant rally this year of over 35%. Next slide, please. Here we can see the overall regional and sector breakdowns for the equity portion of our portfolios. We are well diversified globally and across sectors in line with our benchmarks. Again, all of this, as ever, is available on our website. On the next chart, this really highlights why diversification matters. What you're looking at is the percentage of each index held by just the top 10 stocks. The Nasdaq 100 is over 50% concentrated in just 10 names, and even the S&P 500 is close to 40%. Global indices are also more top-heavy than most people realize. In contrast, our portfolios sit at around 20%, roughly half the concentration of major indices. This is intentional. Our factor-based approach is designed to avoid overdependence on a handful of mega caps and instead spread the risk more evenly across regions, sectors, and company sizes. Next slide, please. Now, you might say, Aman, this all sounds great, but what does this actually mean for the companies that we hold in our portfolio? Here, we've tried to paint a picture and to show you how these changes actually look in terms of our portfolio characteristics. How you can read this graph is the gray bars are the US market, and they've been indexed at 100%. What we're now trying to highlight is for the 5,000 plus companies in our portfolio, what do the average characteristics across size, value, and quality look like compared to the market? What this shows is averaged across those companies in our portfolio, our size is on average 20% lower. The price is 88 cents on the dollar, 12% cheaper, while simultaneously being 7% more profitable. With that, I'll hand over to Wei, an expert on factor investing that I'm delighted is joining us this evening.
Thanks, Aman, and good evening, everyone. I think what I want to do today is to give you a bit more background on what is factor investing and the research and the implementation that goes into the strategies that we design for investors, which you get to access through the portfolios that Aman just talked about. And speaking of factor investing, it is an investment approach that essentially Dimensional as a firm pioneered since 1981. And we have definitely seen increasing interest and adoption of this type of investment approach. And as a result of that, we now manage more than 900 billion US dollars globally for our investors. And those investors range from sovereign wealth funds to endowments to company pensions, as well as financial advisors and investment digital platforms like Syfe. And importantly, as you can see through the last bubble we have there, it is an investment approach that we have been committed to since day one, and our investment philosophy has stayed consistent over time. And we are not in the business of providing you the flavor of the week. We are interested in delivering long-term investment solutions that can stand the test of time. Now, speaking of systematic investing, there's a lot of terminologies, right? People may say quant investing, factor investing, multi-factor, smart beta, a lot of jargons. But essentially, we're talking about this rules-based approach to managing money. So that takes away the subjectivity associated with stock picking. I think Ritesh talks about a lot of the challenges and issues with that approach, and then replace that with rigorous research that identify reliable research return drivers. And then what we do is then to translate those research insights into broadly diversified, low turnover, low cost portfolios that give you those systematic exposures to factors. And then the role of portfolio managers and traders is not to make individual stock bets, but to deliver you that consistent factor exposure in the most risk controlled and cost effective manner. And the benefits of that approach, as you can see on the next slide, is to give you essentially the best of both worlds, both in terms of both passive investing and active investing. So just like, say, passive pure indexing funds, our portfolios are broadly diversified, low cost, low turnover, but we're not settling for just market return minus fees. Our goal is to outperform, just like active, traditional active, but we do so in a much more research-driven and reliable manner. And we have that daily investment process that provides that level of flexibility that allows us to give you that consistent exposure in the most cost-effective manner. And I would say that in terms of what really underpins our strategies is one, the research rigor, two, the implementation expertise. So I'll go into a little bit of both. Starting from research, factor investing has its natural root in factor research, empirical asset pricing. And since day one, we had maintained very close ties with the academic world and working very closely with the brightest minds in the field. So here you can see the academics we've been working very closely with since day one, and many of them have got Nobel Prizes afterwards, and so those are highlighted in yellow. But if you have any familiarity with factor research, and everybody in factor investing world will actually read their papers. So we were talking about Bob Merton's theoretical foundation on ICAPM, so essentially the theoretical foundation for multi-factor investing. We've got Eugene Fama and Ken French. They created the 3-factor model and later the 5-factor model. And Robert Novi-Marx, since we're talking about profitability strategies, he has made breakthrough research on profitability as a reliable return driver. So I think everyone reads their paper, but the company that they are associated with is only dimensional. So I think that already speaks a lot in to the research caliber that we have. And I think because of that academic tie and heritage, our bar for conducting research has been set very high. We're not again, jumping on every new variables out there. We want to make sure the variables that we identify and incorporate into our portfolios can stand the test of time. And I think our track record over the last 40 plus years illustrated that we have been able to do it. And so in terms of sifting through all the different variables and the research out there, the results of that so far on the next slide is that our portfolios are constructed around these reliable return drivers. There's a lot of alignment with what Ritesh and Aman said earlier. So these are company size, relative price, and profitability. So company size, we're talking about smaller cap companies versus larger cap companies. Relative price, talking about value versus growth. And profitability, talking about high versus low profitability companies. So essentially, they tell you something. If you think about what really drives expected returns for any investment, it's the price you pay and what you expect to receive. So using these variables, company size, relative price, and profitability, we're able to identify stocks that are lower price and higher future cash flows. And the combination then gives you higher expected return. And that is an evergreen insight that is relevant today. And even though the market is always evolving, the economy is always changing, but the insights from that valuation framework, that lower price and higher future cash flows should be associated with higher discount rate and higher expected returns for investors, that those insights are evergreen. And then this insight is very much supported by long-term research data. So if you look at the next slide, showing you the data we have spanning almost 100 years across different regions, you can see that from left to right, we have the size, relative price, and profitability. And within each, we show you the results for different regions. So the way to read this, I know there's a lot of numbers there, is that, for example, if I look at the first two bars, we're showing you the annualized compound return of a small cap index, that's in teal, versus that of a large cap index, that's in gray. And difference between the two is positive, and that represents a positive size premium. And the same thing, you can see that there has been a positive size premium over the long term in different regions. And you see that the premiums have been pervasive. And that's also the case when you look at the value premium, looking at the annualized compound return of value companies in green versus those of growth companies in gray. Similarly for profitability, since that's the focus of today's discussion, you see that the profitability premium has been healthy and strong in all different regions as well. Of course, now I'm talking about long-term evidence, right? We all know that any premium and any factor will experience volatility. So it's good to set expectations around the potential range of outcomes and also think about how you can mitigate the potential downside of premiums underperforming. So on the next slide, what I'm showing you now, instead of the long-term averages, are now the annual observations of these premiums. Now I'm showing the return difference. So meaning that whenever the bars are teal, these are the times when the premiums are positive. And when the bars are red, these are the times the premiums actually underperformed. And you can see that just like the market premium, looking at stock market versus T-bills, all the premiums do experience volatility. And that's the uncertainty and volatility is a essential part of investing. But the question for us is then when you think about designing portfolios, how you can mitigate the potential underperformance of the premiums. We don't think you can time these premiums. Nobody has a crystal ball for when exactly the market is going up or when exactly the factor will show up. In fact, we think that having a consistent exposure actually increases your reliability of capturing those premiums, because whenever the premiums come back, they usually are very fast and furious. But the other thing that can be very useful is to integrate multiple premiums. I think that's what Aman talked about earlier about in the S allocation as well. So if you look across these rows, in any given year, you can see that these premiums, they don't move in lockstep, right? In particular, we have seen in the US a period that has been challenging for size and value, right? Partially due to the outperformance of Mega 7 stocks. But at the same time, you can see that high profitability stocks have outperformed. So that has been very helpful in terms of complementing the performance from size and value. So we very much advocate for a multi-factor approach that helps you to mitigate some of the downside associated with any individual premium and help you to smooth out the ride. We are also a big advocate for thinking about strategic asset allocation and maintaining a consistent focus on the factors. And you can see on the next slide, as you stay consistently focused on the factors over longer periods of time, so that discipline does pay off. Right, so you look at the different holding periods from 1 year, 5, and multi 10-year periods, you can see that the probability of realizing a positive premiums steadily goes up. So having that discipline and consistency will help you improve the odds of capturing the premiums. So now these are the research insights, right? We know that the premiums should exist in based on the valuation framework. We have seen the empirical data supporting the premiums. But then how do we put everything in a portfolio? In terms of portfolio design, the next slide shows some of the considerations. There's a lot of thoughts go into the portfolio design, but ultimately the goal is to give you that reliable outperformance in the risk-controlled and cost-effective manner. And that's why for all the portfolios that you get from us, they have very deliberate and targeted exposure to the premiums, and they are also very broadly diversified and low turnover. And the next slide actually illustrates kind of more visually what those portfolios look like. On the left-hand side, these are the core portfolios. So essentially, the squares kind of represent the entire market. So if you sort the stocks from large to small, value to growth, and high profitability to low profitability, you can think of this being a 3D, all right, cube. And what we can do is to start with the market cap weights and then deviate from market cap weights in pursuit of higher expected returns. So basically stocks that are smaller, deeper value, and highly profitable. So the shading, the darker the shading, the more overweight you get. That's the core portfolio. We also have a lot of the component strategies, and then that's what Aman talked about earlier, that essentially give you more targeted exposure to certain premiums. And those are great building blocks for asset allocation purposes. And you can see that, for example, in the bottom row, we have on the left the SMID value or targeted value. So that's really focusing on the small mid cap and value universe. Whereas for profitability, the one that's being added to the asset allocation, that's focusing on large cap and high profitability areas. So you can see it's very deliberate, focusing on a particular segment of markets, but you still see shading in within each segment. That's because within the eligible universe, we're using a multi-factor approach to so that give you multiple sources of value add. And importantly, because we give you that very dedicated asset allocation and deliberate factor exposure, that helps a lot in terms of customizing the asset allocation to get your desired exposure. And that's very different from other quality strategies that you might get. So just to illustrate that, on the next slide, if we focus on the right-hand side, so here now I'm looking, each dot or each circle represent actually one holding in a fund. And then we are looking at in the horizontal axis, that's the profitability exposure. And in the vertical axis, we're talking about value exposure. And you can see that for a high profitability strategy, you'll get that dedicated exposure to basically the right-hand side of that universe. These are high profitability stocks. Indeed, that's what you hold. And it does a good job at staying away from the low probability part of the market. And also a lot of those low probability markets are also value oriented. This is very different from the left-hand side. If you look at the quality funds out there, they don't really give you that deliberate exposure to profitability. And in fact, you get a mix of both value and profitability. So you don't really have that explicit target of either premium, and some of the exposure can be may give you that exposure in a less controlled manner. And the reason for that is that in the end, not all factor strategies are created equal. There's a lot of detail that goes into the construction and management of the portfolios. In particular, when you think about quality or profitability exposure, there's a lot of different variables that people may use to give you that quality exposure. So on the next slide, you can see that while we use profitability as our main way to give you that quality exposure, there's lots of other variables that people have been throwing around, and oftentimes a composite of different things. These include looking at return on equity or leverage ratio or the variability of earnings or net payout and or a blend of all these different things. So it requires a lot of research expertise to actually sift through these variables and see which ones actually give you the most reliable information about expected returns, and whether any alternative variables give you incremental information. And in this case, this shows a research study we did, which basically shows that if you look at a lot of these quality metrics, because quality is more a nebulous marketing term, so a lot of variables can go under that, you actually don't really see them generating reliable return spread like operating profitability. And then if you use profitability already in your investment process and value and size, and all of these alternative variables don't really add additional value. So they can make your investment process make more complex, but not for good reasons. So I think this is just one example showing that a lot of, and the devil is in the detail, that you need to think through what kind of exposure you're getting and how you go about getting those exposures. And I will end on this particular quote from Myron Scholes, who has served on our board for 4 decades, basically saying that on the next slide you can see, in the end, ideas alone are cheap. It's really the implementation that matters. And we're happy to share more details about our implementation and how we've enhanced our investment process throughout our 40-year plus history. I will leave you with the last slide, which is very wordy. So I'm not going to go into any of these. I can probably spend 1 hour on each of the rows, but the point being that, getting your fair share of the premiums requires a lot of implementation expertise, whether it's through security weighting, selection, thinking about short-term return drivers, thinking about your daily rebalancing, and all the things you can do to improve the value of the holdings. We are fighting for every basis point every day. And if there's any chance for us to follow up and share more about these details, we'll be happy to.
Thanks, Wei. I can definitely vouch for the detail and rigor that Dimensional go to when it comes to every part of implementation and trading. I haven't worked for them myself, but I've been involved with them in helping them on trading strategies and so on. In my career, they really do leave no stone of detail unturned. So now let's take a look at our refined multi-asset exposures for core, growth, balanced, and defensive. Just like with equities, our objective here is balance, managing interest rate sensitivity, reducing concentration, and keeping costs low, whilst ensuring that the fixed income and gold portions of our portfolios do their job as diversifiers. Starting with fixed income. Now, bond markets look very different to where they were at the start of the year. What we've done as part of this rebalance is to ensure that the fixed income portion stays appropriately balanced as we head into a new interest rate environment. We're reducing US concentration as well as reducing duration so that bond allocations remain resilient regardless of the shape and speed of future rate cuts. Similar to equities, the US dominates global bond benchmarks, but we don't want the portfolio to be disproportionately focused on US interest rates and be subject to the US interest rate policy by a significant outsized amount. So we've broadened our exposure to high quality global bonds that already exist in our portfolio for some time. Next slide, please. Now, gold, as I'm sure many of you will know, has had an incredibly strong run this year, up over 50%. And so its weight in all of our portfolios has drifted well above its target. We've trimmed it, and this is part of our disciplined rebalancing, allowing us to maintain risk control, capturing those gains, but keeping gold as a valuable diversifier in the portfolios, especially during inflation shocks or moments of geopolitical stress. Now, we've also upgraded the way that we hold gold. We've transitioned our exposure to GLDM, which is 30 basis points cheaper, 75%, whilst preserving the identical underlying exposure. Now, this is a clear example of the detail in our process. We've taken the same exposure and made a trade that implements this much more efficiently for our clients. Next slide, please. Now, again, there's a lot of information here which has been emailed to you and is available on our website as well. In summary, across the multi-asset part of the portfolio, the theme is very similar to the equity side. Broader global diversification, cleaner balance, and cost efficiency. These enhancements have strengthened how the portfolios behave across different market environments, not just when one asset class is leading. Next slide, please. Now, some folks may wonder whether DIY investing can achieve the same results as a managed core portfolio. And look, it's possible to build a portfolio using factor ETFs. Core portfolios offer a much smarter and more convenient solution. With systematic investing, automated features, minimal time commitment, and expert management, core portfolios optimize your long-term returns with far less effort. Next slide, please. Now, just a quick highlight before we move into a Q&A. We've launched promotions for both SRS users and new clients. If you're investing via SRS, the Supplementary Retirement Scheme, for the first time with Syfe, you can enjoy up to $1,500 in fee credits. Separately, new Syfe users can receive 3 months of fee waivers and up to $100 in brokerage credits. And the appropriate promo codes are available here. Full terms and conditions on our website. With that, we're going to open up to a Q&A. Ritesh, back over to you.
Hey, Aman, thanks for covering that. And Wei, thanks for sharing dimensional insights as well. It's incredible. I mean, all the different aspects that we were able to kind of like uncover within a short, span of time. I guess there are some very interesting questions that I can already see and some very pointy ones too, which I think, I'll also rely on the expertise of all of us, but, Wei, on you as well in terms of just articulating some of these points a bit more, thoroughly. So I think the first question and the biggest question, of course, is why should we invest into factors if S&P 500 itself is giving us such, high and great returns in the last 10 years? Maybe Wei, you want to take it up first in terms of why you believe there is, a lot of value incorporating factors in the investment process.
Yes, absolutely. And I think this also goes back to, right, it's very tempting to look at just the historical return and thinking about, setting expectations about the future, in particular about S&P 500. Yes, it definitely has been the darling of investing, right? People asking me, why would you invest in anything but S&P 500? But then if I also go back 10 years before, if you look at the last decade and in 2009, S&P 500, US equities underperformed T-bills over a decade. And that at that time, people were asking, well, why, isn't equity dead, right? Why would I go into stocks? And then what followed that is a bull market, as we all know. So it's definitely tempting to kind of extrapolate some of the past performance. But I would say that, of course, if you're thinking about the broad market, S&P 500 or some of the market portfolios, that's a good starting point, right? You can get you that broad diversified exposure, but you can certainly do better because if you think about tilting towards smaller cap value and highly profitable stocks, that can give you that moderate deviation from the market, but long-term outperformance. And I would also say that, of course, this also is saying, how the factors, especially the size and value factors, have underperformed over the last 10 years, right? We talk about Max 7 shooting the lights out. But again, is that the performance that we should extrapolate on a going forward basis? We have a lot of research showing that if you look at the largest stocks, right, if you look back, they usually give you 20-30% annualized returns on the way on becoming the best, the largest stocks. But on a going forward basis, their performance is not as magnificent. They usually are flat with the market or underperforming a little bit because they are already mega cap growth stocks. So that's why I think in terms of setting expectations, we still think that the factor exposure will set you up better in terms of pursuing that higher expected return.
Thanks, Wei, and very well covered. In fact, I think if you think about like generating returns with stock investing, obviously all of us would want to kind of like maximize our returns, right? Like, so in my opinion, essentially there is you could go to any extent in terms of, generating those excess returns as well. You could actually have a very concentrated portfolio. You can even have one stock and you can say that, oh, I invested into this one stock. Why should I even invest into S&P 500, right? So this argument can be endless in terms of like, you can go and have an hindsight view and then say that, look, this particular thing did so well for me. Why should I look anywhere else? And that I think comes back to also the risk management aspect of it, the diversification aspect of it, and the different sources of return that are just inherent in the market, right? So instead of you trying to pick your own stocks and trying to, outguess the market in terms of where the next set of opportunity is, factor investing actually automates that process for you. It does it in a much more systematic manner rather than, using your emotions and biases coming into play, right? And that's, I think, the key aspect of factor investing, because these factors are not something new. These have been discovered with decades and decades of research behind them. And when it comes to a lot of active managers as well, they claim that they can beat the market, right? So that's their pitch to you, that invest with us because we'll beat the market. And the reality is, more than 85%, 90%, they underperform the market. And I think the research has also shown that when you uncover the details in terms of how these active managers are trying to outperform the market, what comes under the hood is they are, in fact, just utilizing one of these factors themselves as well, because they're trying to pick up. When you think about, oh, I've picked this really great stock which will quadruple and multiply over the next few years, the reality is it's just a small cap stock and its value, so you buy it, and obviously in the long term it does much, much better. So instead of trying to do it in a more active way, if we can do it in a much more systematic way, I think that's where you can drive long-term outperformance and a better risk adjusted return versus just trying to get that market exposure. And by the way, when you're doing these in a much more systematic manner and, utilizing the expertise of managers such as Dimensional, the cost aspect also goes down drastically. So you're not really trying to beat the market, you're getting that market exposure, but you're enhancing it by incorporating these long-term factors in your investment process. All right, maybe we'll move on to the next question. Aman, do you want to pick this up? What are the major emerging markets you have tilted to?
Sure. I mean, the key one to highlight, and this is not a new position or thesis from Syfe. It's a position we've held for some time, is China, of course. We think that China has been systematically underrepresented in global benchmarks. We have previously, of course, in webinars like this, as well as other client events, gone through the fine details there, whether we're talking about GDP, the growth trends, of course, AI. So China really continues to be the biggest emerging market that we have tilted towards, with an approximately 9% allocation within our equity sleeve to China. More broadly than that, we have exposure across the broad set of emerging markets. So that, of course, will include the likes of India, as well as broader aspects across the globe. Now, emerging markets, as part of our equity sleeve, make up around 15% of the portfolio, and this is broadly in line with global benchmarks as well. But China is clearly the position that we have held with conviction and consistency. And of course, this year we can see that the two constituents in our equity portfolio from China are both MCHI and KWEB, but each up over 35%.
Awesome. Thanks, Aman, for covering that. Maybe even the next question as well, given it asks about how we review and upgrade the underlying ETFs or the building blocks to our strategy.
Sure. No, love to take this question. It's something I spend most of my day thinking about when it comes to core portfolios and how we can continue to improve them. So when it comes to reviewing or upgrading the ETFs we're using as part of our core portfolios, it's a continual ongoing process. Now we we have disciplined rebalancing at certain periods of time in the year, but we are constantly evaluating the universe for what is out there as a potentially better exposure or a more efficient way of expressing an exposure. Some of the things that we look at are the methodology of the manager, the performance, the track record, the liquidity of the underlying ETF. Sometimes for newly incepted ETFs or ETFs trading on certain exchanges, we may have liquidity as a constraint for us, given the size we are trading at when we think about trading these core portfolios on behalf of all of our clients. I think cost as well, and this is something very topically we highlighted today, right? We've reduced the cost of the gold holdings in our portfolios by 75%. When it comes to methodology and track record, we've enhanced and strengthened our quality exposure through the dimensional high profitability ETF, which was incepted in the last few years.
Awesome. Thanks, Aman. I'll take the next couple of questions. Oh, I think they just vanished. Will Syfe have a local portfolio, meaning investing into Singapore stocks, not just REITs and managed portfolios? Short answer, we are definitely looking at the Singapore market much more closely as we move forward. In terms of having a strategy dedicated on the managed side, not yet. But there are other ways for you to get these exposures, right? We do have our brokerage vertical. So if you are looking to buy into specific Singapore stocks, you could buy them directly through our trading platform. And by the way, we also have what are called as bundles, right? So if you're particularly yield hungry, then obviously we do have the REIT portfolios that we manage on the manage portfolios discretionarily. But if you're looking at, say, bank exposure and clearly, the three big banks, UOB, DBS, OCBC, then we have a bundle proposition in the brokerage platform wherein you can buy these three bank stocks in one go through a bundle rather than individually trying to buy it. And you can also do it in a fractional way, meaning that, these stocks, the prices are pretty high and you have to buy in lot sizes of 100, etc. So typically it is much harder for people to buy into these individual stocks at one go. With our bundle proposition, you can do it in much smaller ticket sizes as well. So that's, a couple of ways that you can take these local Singapore market stock exposures. In terms of the local portfolio, maybe why don't you reach out to us? And if you could, articulate what kind of exposures you're looking at, we'll definitely be keen to dig deeper and see if there is a way for us to incorporate that into a managed portfolio strategy or even maybe launch another bundle for you. All right. I guess let's take the next one, which is, alluding to the fact that Syfe has never went through a market crash. Are the managers prepared for the event in the near future, judging by current conditions? Maybe I'll kick it off and then Wei, if you could add in some of your perspectives about the different market crashes that we have seen across a more longer, term horizon, and how have some of these strategies and the different factors have performed through these ups and downs as well. I think it'll be a good way for our investors to understand how these factors work and how the diversification aspect of it can help clients navigate through these ups and downs and all as well. So in terms of Syfe has not gone through a market crash, actually not correct. We have been around since 2019. So we've gone through the COVID crash, we've gone through the 2022 interest rate hike crash, and more recently during the Liberation Day where markets fell by more than 20%. So each of these three events over the last 6 years have resulted in more than 20 to 30% drawdown on the equity market, right? And we have witnessed all of these different events. In terms of how you should be thinking about Syfe's proposition is, how did our portfolios perform during these market crashes? And also, I think it's also a juncture where you as investor need to evaluate what kind of investments are you doing, what kind of portfolios are you, investing into, and are the risks embedded in these portfolios or even individual investments that you're doing aligned with your, risk tolerance and long-term goals as well. So over the course of, the last few years, as I alluded to, through these different crashes, if you were to take a parallel our equity 100 portfolio, which is a full equity portfolio, one thing again different about our portfolio versus say an S&P 500 is the fact that it is not a US only portfolio. It's a globally diversified equity portfolio, meaning that you're getting exposure not just to the US market, but you're also getting that exposure into developed market, ex-US, as well as emerging market. And usually, when it comes to returns and correlation and drawdowns, the drawdowns, etc., get diversified away when you have these other exposures as part of your portfolio strategy and not just a concentrated exposure in the US market. And it's even become much more important and relevant in the current cycle because what you are alluding to in terms of judging by current conditions, one of the key risks in the market right now is this concentration risk. And you've really seen the Mag 7, tech stocks really driving the key market indices in the US, as much as 30 to 35% of the US stock market indices, which are market cap weighted, right? And this is again a key differentiation when it comes to how factor-based investing is done versus a market cap-based investing. So when you're doing a market cap-based investing, you're getting the beta of the market. And right now that beta is, I guess like, a little bit, juiced up or a lot juiced up because of these mega cap tech names which dominate these indices as much as 35-40%, meaning that if there is any correction that happens in these specific companies, as much as like, say the top 10 companies within say S&P 500, you can see a much more significant drawdown in your portfolio if you're only invested into the S&P 500 versus if you were to take a more global exposure or even within the US, if you're going beyond the Mag 7, broadening that sector exposure, that factor exposure, these are ways for you to navigate through some of these market crashes much more effectively. Obviously, beyond the equity market, if you are much more risk averse in nature, you should also look to add other asset classes in your portfolio from a diversification standpoint, including fixed income as well as commodities. And that's what like the other core components of our portfolios enable for you. So the equity 100 is a full equity portfolio, but if you're looking for across asset class diversification, then you should also look at our core growth, balanced and defensive portfolios as well. Maybe Wei, if you want to weigh in on this as well.
Yes, absolutely. Because I think in the end, uncertainty and volatility is certainly part of investing, right? So how you deal with it comes from both in terms of asset allocation, having your asset allocation that matches your own risk tolerance, right? I think Ritesh, you talked about, a most important lever you can pull is in terms of how much you want in equities versus other more defensive assets. But then in terms of the investment strategies, we as a firm have gone through periods like global financial crisis, the more recent, COVID-19, we've seen sharp market downturns, and then also in our research data, we have seen bulls and bear markets going back 100 years in the U.S. And I think a common theme that you see there is that discipline is the key. And also you want to make sure you have a portfolio that's robust enough to go through those ups and downs and doesn't get blown up, right? So that's why I think being broadly diversified is your first line of defense always. If you have very concentrated portfolios or even you have levered up and those type of portfolios, then you may not be able to hold up during those periods. But if you have a broadly diversified across different regions and sectors and also asset classes, then if you can stay disciplined through those up and downs, we see that over the long term, that discipline has paid off for investors. And then I think that also speaks to when it comes to investment solutions design, it's not so much about predicting what exactly will happen, because nobody has a crystal ball about the future, but you need to make sure you are prepared for what can happen, the range of outcomes. And there, in terms of thinking about, predicting the future downturns, we actually don't really think that you can precisely predict when exactly that will happen. But then making sure that you have the flexibility and you have the discipline when that happens, that's quite important. And when it comes to the investment solution that we manage for our portfolios, we think that it's quite important to keep that consistent focus on the factors, because we see that after market downturns, the subsequent returns on average can be quite positive, and also the subsequent returns on the premiums are also sizable. So you don't want to be out of the premium or out of those market. In that way, you will not never be able to catch up. But then in terms of the implementation, that's the key. Because whenever events happen, and there's any market stress, any liquidity dry up, it can be very costly to if you don't access the market in the right way. If you trade in and out based on stale information, if you don't have the flexibility, you're forced to trade in and out, you will pay a very high price, because you see that execution price goes up when volatility goes up as well. That's where the implementation expertise becomes even more important, precisely in those moments that you want to make sure you are not trading on noise information, and that you are keeping your costs low, and your discipline and also flexibility can actually add value in those periods if you are able to take the other side of the trade.
Thanks, Wei. If we can go back to the list of questions, yes. All right. I think the first one really is a question around what is the right portfolio for someone who's at 65 and looking to invest for the next 10 years. See, generally, it's a more personal question than just the time horizon. So in general, I would say at this age, and if you're looking at 10 years, it's relatively long term from a perspective of the time period itself. But obviously, we don't know the other circumstances at this juncture. So I would encourage you to reach out to us, and we could definitely guide you much better. But in terms of, at least from a portfolio perspective, I would definitely recommend a multi-asset portfolio. So one of the, core balanced growth or defensive, but it needs a little bit more input from you in terms of what would be the right, right portfolio given, what your objectives are as well. Purely because the core defensive is a good portfolio, but it's got only 25% equity. So if you're looking to generate a little more higher return, then obviously you will need to dial up that equity component, meaning that take either the balanced or the growth portfolio. And given that you have 10 years of time horizon, these basically mean that you should be able to navigate through some of these, market corrections and, ups and downs effectively through this period as well. All right, let's take the next one. Okay, let me just scan through. There was one question about, our exposure to the US in the, yes, Syfe core portfolios are still very US allocated, but in your sharing seems like Syfe is moving away from US market exposure. Is it contradicting? So I think maybe it was not very clear in one of our slides in terms of how we have rebalanced our portfolio. One of the key changes that have been done in this particular rebalance is the exposure ex-US has been, increased. And this goes back to some of the market outlook sharings that we had done, as well as, long term, we want to be much more closer to how our returns stack up against, say, our key benchmarks that we follow as well. In general, the US had dominated returns over the last decade, right? So it made a lot of sense to have a US heavy allocation in that kind of time frame. Going forward, as we look at a more broader set of investment opportunities, it makes a lot of sense to look not just within the US, but also beyond the US. So as part of this rebalance, our US allocation in the equity portfolio has gone down to 65% from 70+% that it used to be pre the rebalance. And the extra, allocation that is, then shifted to the emerging market and the developed market ex-US as part of this rebalance as well. So I would say not a contradiction. It's just, adjusting to the new market conditions, and also positioning it, for a better return outcome for you as investors. Okay. Okay, Wei, I think there is one question for you. You shared about portfolio exposure metric comparisons. Is this only specific to US market, or does it also apply to other markets?
I think this refers to when I talk about profitability versus alternative quality metrics. Yeah, I think, this is not just specific to the US. I think we have seen that overall, a lot of these alternative metrics, whether it's value metric or quality metrics, don't really add incremental information about expected returns than, using value, price to book, and profitability. And in fact, if you're interested in learning more, we recently wrote a paper with Professor Robert Novi-Marx, if you remember, the academic that has done the first breakthrough in profitability research, and it's called Profitability Retrospective. What have we learned since then? And it really shows how profitability provides a unifying framework for understanding quality investing, defensive equities, alternative value strategies, and so on. So in a way, if you think about all the different metrics out there, right, it's like a big dartboard, but profitability is really the one that hits the bullseye. And then that's quite important for us to be very selective in terms of the metric we use, because in our minds, less can be more, because if you have more moving parts, more complexity, it can also lead to potentially more turnover, and harder to understand performance, and so on and so forth. So we do think that simplicity, in a way, is the ultimate sophistication, and then we want to, continue to strive to achieve that.
Awesome. Thanks, Wei. Maybe I'll just take a couple of questions myself, and then I think, Wei, for you, there is one more question that I would like you to answer, and Aman as well, and then we'll wrap it up. Let me first go through. If you go down, please. I think this question around, you've been an investor with Syfe for a while now. One area which you feel noticeably lacking is regular follow-up and portfolio reviews. Investors would really benefit from a proactive guidance and recommendation. Thanks for the feedback. Like, we hear you. We have been, in terms of like actual communication and guidance recommendation, I would encourage you to, keep looking at the Syfe app, especially on the homepage, right at the bottom. We now give weekly advisory insights. We also publish weekly advisory videos so that you are constantly on top of the market in terms of what's going on, and even in terms of some of the action points that you could potentially take. In terms of the portfolio reviews itself, we are kind of like, constantly also communicating whenever we do, make changes to our portfolio. So, but the only thing that I would, suggest here is we are not an active manager here as well. So the intent is not to react to every, market noise and every market movement. These are long-term allocations that we do into our core portfolios. And what that means is, in terms of, rebalancings and shifts, you might not see so many of them happening. And, that is intentionally done because we want to be long-term invested into some of the key, return drivers, including the factors as well as the market beta. And that's where I think, overall, we want to, make sure that you get that smooth experience rather than we reacting to every market noise. How do I diversify beyond the US? Please do look at our core portfolios. So they will definitely help you diversify beyond the US. It has exposure to developed market, ex-US, as well as emerging markets. Some of the, in fact, changes that we have done to the portfolio increases these exposures to our core portfolio. So, of course, as you move forward, if you're, again, concerned about the concentration risks in the US market and looking for a more, diversified portfolio across geography, sector, and factors, then definitely, please take a look there. Wei, I think, it'll just be great if we can have a much more simpler definition of factors, because we have talked about factors, through the start of the session, but looks like there are still some folks who don't understand what factor exactly mean. Maybe
Yeah.
if you could, take this up and, we can probably wrap it up in the next, couple of questions. But more importantly, I think this is a key aspect of our investment proposition, and Dimensional really leads, this as a thought leader. So would love to get a perspective in terms of how, for an average investor, they should see factors and understand factors.
It's not a simple question, I would say, different ways you can take it. But, of course, it has its academic, sense, thinking about factor models, basically how they capture, the common movements across stocks. But I think for the purpose of today's discussion and also the strategies our, clients invest into, think of them as return drivers. Think about them as variables that you can sort stocks on that generate that systematic return variation. So for example, when I say high profitability as a factor, what we mean by that is if you look at, say, 3,000 stocks in the US, you could rank order them from the highest profitability stocks to the lowest profitability stocks and put them into buckets, let's say 4 different buckets from highest to lowest. Then the highest buckets will have the highest expect returns, and you do see that historically they have had the highest returns. And then the next bucket has slightly lower, and then when you go down, you see kind of monotonically average returns vary across these buckets as you sort on that single variable. That's why it's useful for portfolio construction, because then systematically which groups of stocks should have higher returns versus which groups of stocks have lower returns. And then you can combine multiple factors, so multiple variables. You can sort stocks on many of them. So some stocks are mega cap growth, so they should have lower expected returns, but at the same time, they may be having high profitability, so that helps with expected return. So the resulting exposure and how much you want to over or underweight those stocks will be the joint effect of their kind of multiple dimension, or the different characteristics that they represent to you. I don't think it's actually simplifying things, but hopefully I'm not adding more confusion there.
No, absolutely. I think it does, address at least in terms of like how, from an exposure standpoint, people can just buy the index, but obviously through these factor exposures, you are, getting that extra bit, right? Like, think about, like, I'm not sure, like, Aman had some really nice analogies previously. You could, have a basic meal, but, if you want to really enhance it, you could add a lot of, high protein, high, caliber ingredients to it. So that really helps you from a health standpoint, get a much better, food composition that comes in, and, results could be much more better as well. So that's the kind of, analogy that I could think
Interesting,
of at
yeah.
this
And a
juncture.
balanced diet, balanced tilt is preferable as well.
Awesome. Aman, do you want to close it out by taking maybe the last 2 questions on the, tax efficient ETFs, as well as why not QQQM instead of QQQ?
Sure, absolutely. There's 2 things I love: analogies and ETF screening. Understanding the brutal detail of whether we should make a switch or not. Let's start with the tax efficient ETF. So this is alluding to UCITS ETFs, which are domiciled in Ireland, generally traded on the London Stock Exchange, and subject to 50% reduced withholding tax compared to US ETFs, meaning the dividend withholding tax is 15% instead of 30%. Now, during our last rebalance, we made a few UCITS switches, and as of then and indeed today, more than 40% of the ETFs across our core portfolios are in UCITS vehicles. Now, the decision to swapping a US ETF to a UCITS ETF essentially is a calculation, and it's taking into account the dividend withholding tax saving compared to what can sometimes be increased costs, reduced liquidity, and increased bid-ask spreads potentially on the UCITS ETFs, which typically trade wider and thinner than their US counterparts. So we do an all-in calculation, and actually we have a watch list of all of our US ETFs, what the equivalent UCITS exposures would look like. Does that switch make sense mathematically, going right down to the basis point, and then will we make that switch or not? So it's not always a straightforward yes, there's a UCITS exposure, and so I should take it. And that's why it's not 0% nor 100% of our portfolio is UCITS, but it's well over 40% across the core portfolios. So watch this space. We are continually evaluating from a UCITS perspective. Very much on a similar theme. Let me take the last question as well. Triple QM is a similar exposure to Triple Q, the Nasdaq 100 exposure that we have, tech heavy, of course, as we covered earlier. Now, when we last checked it, Triple QM is up on my Bloomberg watch list. The spreads for Triple QM were almost 5 times wider than for Triple Q. And in terms of daily volume, depending on the day you looked, it could be anything from 10 to 20 times less volume traded on Triple QM. For now, given the asset base that we are now proud to manage as part of these core portfolios at Syfe, and doing that on behalf of a vast number of investors, at this stage, the liquidity is still a nagging issue, and the calculation doesn't make sense at this point. What I'd say though is this is very much on our watch list, and if the dynamics there change in terms of liquidity and bid-ask spreads, then we would be looking to make an adjustment there. And it's something we continue to evaluate, much as we have made that switch for GLD and GLDM that we talked about earlier this evening.
Great. Thank you, Aman, and thank you, Wei, for joining us today. Incredible session, great sharings. I hope, all the folks today got a good sense of how we manage our core portfolios. And if you're looking to invest for the long term and solve for some of your core financial needs and goals, including, for example, saving for retirement, saving for, child's education, buying, your new next big house purchase. Some of these are longer term investment that you want to do, and typically it needs a more growth oriented strategy, and that's where our core portfolios can give you that growth, but in a much more smoother way, in a much more diversified manner, and also with value add, being that it is not just a market portfolio but has these factor enhancements that can help you drive that long term better risk adjusted returns as well. So please feel free to reach out to us. I think we've not been able to take all the questions, but we tried to address as many as them as possible. We are at 8 p.m. plus. Wei, I know this is late. Thank you once again for staying back and answering all those questions for our clients as well. And Aman, fantastic job as usual. So